morning, everyone. I'm John Kogan, CEO of Performative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone today to the webinar, China M&A, Tax and Structure Considerations. China is the world's fastest growing major economy. Many U.S. companies currently have or would like to have a structural presence in China. However, acquiring and maintaining such a presence is a tricky undertaking with many legal and tax issues involved. Companies need to either find ways around or through these issues in order to exist, survive, and thrive while doing business in China. This webinar will bring you the latest information on structural and tax issues facing foreign companies that desire to have a legal presence in China. This knowledge will be brought to you by experienced Chinese law and tax issues representatives from Baker McKinsey, the world's leading global law firm. And on that note, I would like to thank Baker McKinsey, a firm steeped in the legal ins and outs of doing business across borders, for helping us make this event possible. A brief note on today's agenda. First, we will hear presentations from our two speakers, who I will introduce momentarily. And then we will move to a panel discussion for the tail end of the webinar. I strongly encourage you to ask any questions you have during the event at any time using the questions box in your GoToWebinar control panel. We will hold those questions until the end and then ask as many of them as we can get to, given the time allotted, and then we will do our best, along with the speakers, to address any questions that we don't get to after the event, either directly or via the Performative forum. Please note that we will be sending out soft copies of today's presentation to all attendees within 24 hours of the event finishing up. We will also send out CPE credit certificates for the CPAs in today's audience who requested CPE credits. If you did not request those credits when you were registering, there's information in the chat area, contact information for Tanya Walsh, who manages our CPE program. Please feel free to contact her, and she will make sure that we get you that information. Before we get started, a quick word on Performative for those who are new to Performative. Performative is the largest and fastest growing online community and resource for senior level corporate finance, treasury, and accounting professionals. The site is entirely ad-free, entirely noise-free, with no advertising and no selling or promotion allowed. And there are more than 200,000 CFOs, controllers, treasurers, and others who are involved with Performative. We're a resource where corporate finance and related professionals excel in their careers through a uniquely valuable online peer network, direct subject matter expert advice, and other valuable features and resources. And all of it is completely free to the users and completely noise-free. We invite you to check it out at performative.com. Today's learning objectives, after today's events, you'll be able to apply some of the latest knowledge of China M&A and tax and corporate structure issues to your company. Obviously, we advise you to seek professional help, like the folks speaking on today's call, or your counsel. But you will pick up a lot of great information and very current information on these subjects today. And this will help you optimize your company's corporate structure for China holdings and your strategy for how you might approach your holdings in China going forward. And with that, what I would like to do is introduce today's two distinguished speakers. First, Brendan Kelly, who's a partner at Baker McKinsey LLP in Shanghai. Mr. Kelly has over 12 years of tax advisory experience. He has performed a wide range of analyses of various industries with regard to China tax implications, and he specializes in advising cross-border clients on tax and legal implications of investment in China. He also has a wealth of experience in working with multinationals to establish contract manufacturing operations in China, develop integrated supply chain structures, and assess opportunities for tax restructuring in a post-tax unification environment. Prior to joining the firm, Mr. Kelly was a partner with the Tax and Business Advisory Services Group at the Beijing office of a Big Four accounting firm, where he led their international tax planning group for Northern China. Also, I would like to introduce Jinghua Liu, Special Counsel, Baker McKinsey Shanghai. Ms. Liu provides advice to multinational clients on PRC taxation, international tax planning, general corporate, and employment law issues. Ms. Liu is a member of the New York State Bar Association and graduated from the University of International Business and Economics with a bachelor's in economics. and at the University of Toronto Faculty of Law with a JD, and BU Law with an LLM in taxation. She's a member of the New York State Bar and has obtained the PRC Legal Profession Qualification Certificate. And without further ado, please take it away, Brendan and Jinghua.
Thank you very much, John. It's a real pleasure for us to be here. Baker McKenzie really enjoys the opportunity and appreciates the opportunity to be joining all of you this evening, and Proformative for giving us the chance to connect with such a wonderful group. As John described, our intent today is to talk about China M&A tax and structuring considerations. As we find with all these presentations, we're always very ambitious about the amount of information that we can cover in a short period of time, and so we'll try our best to cover all the slides, but we apologize in advance if we go over anything a bit too quickly or we have to rush through any area that you find of interest. But as John said, please feel free to ask those questions, and we'll try to cover what we can during the session or afterwards if not. So with that, I suppose we'll just jump right into it, and if we could kind of move on to sort of what we're going to talk about today on slide 2. The areas we're going to talk about today are structures people are using from a holding perspective in China, how those structures and how those holding structures have changed in a very meaningful way due to a variety of changes in regulations in China over the last few years, and then how that impacts your profile when you're thinking in terms of M&A transactions. So jumping into sort of the typical holding structure, you see a typical holding structure in China that people would set up would be, with a U.S. parent company. On slide 4, you see that a U.S. parent company quite often is going to have some sort of regional holding company, and in turn, that regional holding company is going to select a vehicle that is going to enable them to take advantage, ideally, of a preferential treaty with China. So basically, what people are looking to do is, because China instituted withholding tax starting January 1st of 2008, there's a much greater desire than there ever was in the past for people to actually to use vehicles where the small set of companies or countries out there that has a 5% withholding tax rate under the relevant treaty. In other words, China's domestic rate historically had been no withholding tax on dividends. China changed that rule starting January 1st of 2008 to a 10% withholding tax. And with that 10% withholding tax, there's a much greater desire or need to minimize withholding tax down to the 5% level. And so moving on to the next slide, if we can, on slide 5, what we'd want to talk, or this just gives a quick sample, and we'll skip through it fairly quickly, of jurisdictions where that have some of these beneficial rates, Hong Kong and Singapore being probably the most popular of those locations. But as Jinghua is going to talk about as I hand it over to her here, the ability to access those beneficial rates, those lower 5% withholding tax rates, has become far more challenging over the last, say, 18 to 24 months, as China has instituted a variety of anti-avoidance measures designed to both keep companies from inappropriately accessing treaties when the vehicle that in question doesn't sort of have sufficient substance or commercial purpose to satisfy the authorities. More substance is really the key. But then at the same time, we're going to talk about a variety of concerns that when it comes to time to exit from a Chinese investment, historically people would invest through that holdco too, but that's not necessarily going to be possible anymore for some of the reasons we're going to describe a bit further. So with that, I'm going to hand it back over to Jinghua to talk about some of the actual specific changes that have happened recently that very heavily impact our ability to use sort of traditionally tried and true methods that have had to change very, very meaningfully under this change in the anti-avoidance environment in China. So with that, I'll hand it to Jinghua.
Sure. Thank you, Brendan. But unfortunately, I don't think I have the control of the slides. John, I guess you are controlling them, but this is fine. Then let's now move on to slide 7. So I'm going to first talk about some general anti-avoidance regulations that China put in place since the reform of the China's enterprise income tax law. There are anti-treaty shopping and anti-indirect equity transfer rules I will discuss. And then we will talk about some structuring ideas, how you need to deal with these anti-avoidance rules for your operations in China and in your M&A deals. And then I'm going to briefly go through a couple of high-profile cases on this anti-avoidance area. Then we will connect all these new rules with the tax dispute resolution recent development in China. So let's now turn to the anti-treaty shopping rules first on slide 9. Well, as Brendan described at the beginning of the presentation, the traditional holding structures have two major tax benefits. The first one is that you get these treaty preferential rates on dividends, interest, royalties, these type of passive incomes. But China put in place some anti-treaty shopping rules listed here on slide 9, which now require, first of all, the taxpayer will need to file application to the tax bureau. So the treaty benefit is no longer automatic. You need to submit relevant documents to the tax bureau to prove two major things. First, you need to be a tax resident of the treaty jurisdiction. So basically, the company needs to obtain a tax resident certificate from that jurisdiction. That's under Notice 81. And another key requirement is that the company claiming treaty benefits need to be a beneficial owner of the income, be it dividends or interest or royalties. So in order to be a beneficial owner, the tax bureau will look at whether the holding company has economic substance, whether it is a conduit company. If it is a conduit company that does not have any employees or income or assets, and the income just passes through, then the Chinese tax authorities would likely deny the treaty benefit. So that's basically the anti-treaty shopping rules. And then moving on to the next slide, slide 10, about the indirect transfer. This Notice 698. I guess a lot of you probably have already heard about Notice 698. It is similar to the Indian Vodafone case, where the Chinese tax authority would like to tax an offshore transaction. So you could sell your U.S. company, your Hong Kong or Singapore company, but if that company has a Chinese subsidiary, then there's this Notice 698 would apply. And the two major rules we want to talk about under Notice 698 are the reporting obligation and the recharacterization, which is really the taxation rules. So on slide 10, that's the reporting obligation. An offshore transaction will need to be reported to the PRC tax authorities if one of the following two conditions is satisfied. The first one is if the company being transferred, so that's the holding company being transferred, that jurisdiction has a relatively low tax rate, which is 12.5. That's 25% of the, sorry, that's 50%, half of the China headline tax rate. So if that jurisdiction's tax rate is lower than 12.5%, then the offshore transaction will need to be reported to the tax bureau. There's a recent clarification of Notice 698 where the PRC tax authority says that the tax rate is really not the general tax rate on the headline tax rate of the jurisdiction, but the tax rate on capital gains. And there are jurisdictions where capital gains are exempt from income tax, or in jurisdictions where capital gains are taxed at a lower rate. So this new clarification probably going to catch more jurisdictions than the original rule. So that's the first condition. And second condition is that if that jurisdiction does not tax foreign source income, and the new clarification also provides that by foreign sourcing income, the tax bureau really means foreign source, the capital gains income. So if either that jurisdiction does not tax foreign source income, or its tax tax rate is below 12.5%, then the offshore transaction will need to be reported to tax bureau. So if you have a holding company, say in Hong Kong or Singapore, then that transaction is reportable in China for sure. But then the question actually is, for example, if you're selling your holding company in Luxembourg, in Ireland, or even a subsidiary in the United States, would that transaction be reportable in China? That's probably still subject to dispute. I think the tax officials in China, if you ask them, they would probably say it's all reportable. But if we look at the rules more carefully and from a technical perspective, there's probably some argument that certain offshore transactions, if the holding company is in the locations I just mentioned, like United States, UK, Luxembourg, then you probably have some argument not to report that that transaction. And Brendan and I would discuss the relevance of that together with the actual taxation of the transaction later in more details. And now let's move on to slide 11. That's the second prong of Notice 698. So I just mentioned the reporting obligation, but reporting does not mean that transaction is taxable. After the reporting, the PRC tax authorities would look at the facts of the transaction, and if they find that the offshore transaction does not have a reasonable commercial purpose, in other words, if you could have done the transaction directly, you could sell the Chinese subsidiary directly instead of selling the offshore holding company, then they would conclude that this is a tax avoidance transaction, and therefore they could recharacterize the offshore transaction as the direct sale of the Chinese subsidiaries, and therefore tax you on the gain from the transfer. So that's the two main provisions of Notice 698. But let's move on to the next slide and see what's the key message and the key issue we need to look at when we analyze which transaction should be taxable, and how to try to minimize your tax exposure in China. So in the previous slide, I mentioned that the key consideration of whether an offshore transaction is taxable in China is whether that offshore transaction has reasonable commercial purpose. But you probably also remember that when I talk about the anti-treaty shopping rules, I talked about another concept, economic substance. So now the question is, would economic substance equal to reasonable commercial purpose? In practice, from the cases that we have seen recently, the PRC tax authorities, when they look at 698 cases, they, in a way, equal economic substance to reasonable commercial purpose. So when they look at the offshore company, the questions they ask would be whether the offshore holding company has employees, has other income, has assets, whether it has paid tax in its own jurisdiction. So all these questions, they're actually economic substance, not reasonable commercial purpose, because reasonable commercial purpose could mean much more than economic substance. You could have a company that does not have any employee, any assets, any income, but it could have perfect commercial purpose to exist. For example, if you are going to list a company, then this company, even though without any substantive operation, it could still serve a lot of functions. For example, to provide a good corporate governance structure for its investors. It could have performed this management of investment functions, cash pooling functions. So there are lots of reasonable commercial purpose. That does not necessarily mean that a company needs to have economic substance, but in practice, we've seen that the PRC tax authorities, they only look at economic substance. So that could be a problem when you have offshore transaction and when you report to the PRC tax authorities. That's why in a lot of cases when we dealing with these 698 cases with our clients, we kind of trying to distinguish the two provisions, the reporting obligation and whether the transaction is taxable. We are going to discuss this later in the later section. So, Brendan, back to you on the responses.
Thank you, Jinghua. Yeah, so I mean, the question then we all ask ourselves, what does this mean? I mean, China has gone from a environment where people would regularly set up prior to 2008. They would set up Cayman and BVI and other tax haven type companies because they weren't worried about getting treaty benefits, and their main goal was to be able to exit China on a tax-free basis. And by selling the entity above, or maybe several tiers above China, they avoided doing that. So they sort of would have SPV, Special Purpose Vehicle 1, China 1, SPV 2, China 2, something like that. Where have we gone from there? As Jinghua described, you no longer can do that exit on a tax-free basis because of Notice 698. They're really going to beat up that structure and try to understand if it has real commercial purpose to it. Perhaps that needs to be substance. And then when you talk about getting treaty benefits, you also need to have substance in order to access those treaty benefits. So what does that say now? What that says now is you're going to have that holdco, the Hong Kong Singapore company, more likely to hold multiple subsidiaries, have operations, back office functions, and employees, maybe other income, other activities, not going to be in classic tax havens like Cayman, Bermuda, BVI. And key element also here that the entity receiving, the Hong Kong Singapore company receiving those dividends and that income, that it does not have an obligation to immediately distribute it or move it to another party, because then it would sort of be seen as a conduit from a Chinese perspective. So from a 698 perspective, what we then talk about is that assuming and understanding that what we need to do with new structures, if we have the opportunity to sort of wipe the chalkboard or grease board clean and sort of start from scratch, we realize that we've got to put a lot more substance and a lot more meat in these holding vehicles because we're not going to be able to exit tax-free. But what do we do when we've got structures that sort of look like they're good and they have good reasonable commercial purpose under Article 6, under the recharacterization provisions that Jinghua just described, but we're concerned about the reporting because the reality is that none of us really want to put a big stack of documents on a local Chinese tax authority's desk and say, hey, do you think you'd like to track tax this transaction? That's not a question we want to ask. That's not how we want to do things. So we talk about a couple of methodologies over the next 2 slides. Very quickly, the first one, issuance of new shares. If the Hong Kong company, in fact, issues new shares, could we, in fact, potentially avoid a 698 issue because instead of transferring, in quotes, the Chinese term is zhuanrang, we're not doing a transfer, we're issuing new shares. Could that perhaps, by doing sort of a share flood from seller basically having the holdco issue shares to the buyer and basically diluting out the seller, could that be a way to avoid having a transfer? Then if you look at kind of the next slide as an alternative structure to that, and the next slide is a bit more complex because there's a lot of things going on here. China Business Trust is a fairly complex structure. But the basic idea is that on a China Business Trust structure, the reason it's potentially an opportunity from a 698 perspective, and we can see this in other areas as well, is that if the legal title to the shares in the Chinese subsidiary don't actually move, can we argue that there's not a transfer? So could we either have a situation where basically the legal title holder to the Chinese shares either does a split of its beneficial ownership and its legal title so that it sort of transfers beneficial ownership to another party, or if it were a trustee in a trust, could we continue to have it be the trustee, or if it was the current legal title holder, could it become a trustee so that now the shares are held for the benefit of somebody else, but the legal title hasn't changed? So these are the types of things we're spending a lot of time on. As Jinghua said, if you talk to the tax authorities, they very much will tell you that they know about these things, they don't like them, they think that they violate the rules. But the challenge is, do they violate the rules that have been written, or do they violate the rules as they wish they had written them? And that's one of the challenges in China that we'll talk a little bit in the disputes area, because the rules are written in a certain way, fairly plain language. Chinese speakers like myself and native speakers like Jinghua, who actually can look at it and say, look, if they really wanted to capture certain types of transactions in certain situations, they could have written it a lot better. So what ability do we have to, if you will, exploit or take advantage of the areas where there is, in fact, some openings? Because if you really follow the rules in a very conservative fashion, they're going to cripple basically almost all meaningful global restructurings, because Chinese shares could be 6 and 7 tiers below a structure, and China could be a very small part of the transaction. Nonetheless, you could have a Chinese reporting obligation. So China has really become a very challenging jurisdiction, and it sort of nosed itself into the discussion on transactions that probably had nothing to do with China in their inception. So with that, let's just talk about some reorganization slides that Jinghua is going to take us through.
Sure, thanks, Brendan. So now we move on to the next slide. This 698, as Brendan mentioned, is going to catch a lot of transactions, even some internal reorganizations. So you probably have an internal reorganization in the U.S. that should be tax-free, but with 698, if you report to the PRC tax authority, and they may tax you, because in China, the tax-free internal reorganization rules are very strict. There are very few type of transactions that can qualify for tax-free treatment, especially for cross-border transactions. There are only very small number, actually 3 type of cross-border transactions can qualify for tax-free treatment. But here, we probably can take advantage of one of them. So here, for example, you can see on the slide, if a U.S. parent holds BVI holdco, which has a Chinese subsidiary, and wants to transfer it to another company within the group, then the U.S. company can set up another subsidiary, the Netherlands holdco, which needs to be 100% subsidiary of the U.S. parent. And the U.S. parent can drop BVI holdco under the Netherlands holdco. That is a U.S. company transferring its subsidiary to another 100% owned subsidiary. This transaction, this type of transaction in China would qualify for tax-free treatment. Therefore, if we have the PRC tax authorities disregarding BVI holdco, Hong Kong holdco, to disregard all these holding companies and deem the transaction as the U.S. company transferring the Chinese sub directly to the Netherlands holdco, then we could argue that this actually is a tax-free reorganization and should now be subject to PRC tax. But I need to caution that these probably technical sound arguments, and in the current environment in China, some tax officials, they probably don't follow the technical arguments strictly. And that could be illustrated by the cases that I'm going to briefly discuss. So let's move on to the Jiangsu case. This is a very famous case. You probably all read in the newspaper. That's actually the big PE fund company, Carlo. They had this investment in China, and they transferred to a U.S. buyer. The Chinese, they didn't report this transaction under 698, but the Chinese Tax Bureau tracked it down through these public available information. They actually found on their website saying that they have sold their Chinese business, and the Hong Kong company was actually not even mentioned on the website. Therefore, the PRC tax authority concluded that the Hong Kong holding company does not have any economic substance or reasonable commercial purpose, and therefore this transaction has been deemed to be a direct transaction of the JV interest in China. The tax bill is big. It's RMB 173 million, and which I think is about US dollars 25 million. So that was the biggest single tax collection case on a non-resident enterprise at that time. And then the next two cases, I'm not going to go to details of them, but these two cases, one is about a direct share transfer where the taxpayer wants to take advantage of the Barbados tax treaty, which at that time had a capital gains exemption, but the tax bureau denied that treaty benefit based on that the Barbados company does not have any substance. It was a conduit company. And the next case, Fujian case, that was about a Hong Kong individual having two Hong Kong subsidiaries, and each of them then holds some shares in a China-listed company. Under the Hong Kong-China Treaty, if a Hong Kong resident holds less than 25% of Chinese company shares, there's a capital gains exemption. But the tax bureau deemed this because the two Hong Kong holding companies are under the same control, so altogether the total shareholding is more than 25%. Therefore, they tax the transaction. However, these two cases, they are not. If you look at them, they are actually not technically sound, because in the first case, capital gains exemption under the treaty does not require the seller to have economic substance. There's really no beneficial ownership requirement for capital gains exemption. And on the Hong Kong case, if they're going to disregard the two Hong Kong holding companies, then the Hong Kong individual should be taxed at a different rate, but they tax, they still impose the tax under the corporate rate. So these two cases, they have actually gave concerns to the tax practitioners that how the PRC tax authorities would follow the rules, or they would just find some rule if they want to impose tax. So then I guess Brendan will now talk about the tax dispute resolution and how we see that non-resident enterprises probably should deal with these changes in China.
Thank you, Jinghua. John, if you could skip down to the slide that's titled Tax Collected from Non-Resident Enterprises, so one more slide down. The first slide that John skipped past quickly that you can take a look at later talks about China's total tax revenue. So you can see tax revenue from non-resident enterprises, that's all of you, okay, has basically doubled from 2008 to 2010. And to see that kind of increase in collections during a time when, you know, the global economy wasn't at its best, gives you just an indication of how aggressive the authorities have been. So if we move on to the next slide, the question for us becomes, with the changes that have been described, the very aggressive anti-avoidance regime that's now in place, to what extent, when you find that these rules have gone too far, you disagree with them, they've applied an incorrect basis, as Jinghua has described, or something of that nature, what do we then do? How do we deal with it? Is litigation, is there sort of a form of recourse? That's the question. And as you can see here, the statistics on litigation, these are unofficial statistics, would seem to show that a lot has happened. But the key is, if we hit the next button, is that cases for multinationals are nearly non-existent. Basically, multinational companies effectively never go through this process. So if you move on to the next two slides and you see the settlement process and a brief chart of how that process would be, we could depict it. The reality is that's something that multinationals typically are never going to touch or never going to be willing to touch, because there's call it a gang mentality. Basically, there's a fear of retribution, for lack of a better way to describe it, such that going over the head of the authorities to try to deal with issues is a very, very dangerous proposition, and so people almost universally settle it. But if we move on to the next slide, the question now becomes, has China gone far enough by going and trying to attack, for example, and tax a transaction that's maybe 6 tiers above the Chinese shares through this Notice 698, for example? Have they gone far enough that people are eventually going to start to use things like tax litigation, competent authority, other sorts of forms of more dispute-oriented methodologies to try to sort of deal with the tax authorities, and not just accept or roll over to the conclusions they draw? Look at it on the transfer pricing side. There's a lot of pressure globally on the transfer pricing side, such that it's not realistic in many cases to just accept the fact that Chinese authorities want more revenue. You can't necessarily accept that when you know you're vastly overcompensating your Chinese operations. So there's a lot of pressure on other sides here. And then if you look at tax retreatment and corporate reorganization, a lot of the terms are not terribly well defined, but at the same time, if you feel like you've satisfied those rules very clearly, and the authorities may just deny them because they're looking to shake down more revenue, what's your recourse? What can you do about that? And at what point do you have a big enough ticket item, big enough cost, that you would actually go through those steps and try to actually go through some sort of dispute-oriented litigation or appeal or something of that nature? So it's very speculative at this point, but we do believe over time that this is going to become more of a reality in China, where right now litigation is basically non-existent, and so people effectively accept the need to negotiate and deal with the authorities on a very one-to-one basis, on a settlement and discussion basis. So when you think about it, as we sort of move into the next area of M&A that Jinghua is going to talk about, the question then becomes, in the M&A context, when there's so much uncertainty, how do you deal with it? How do you deal with it in an asset and share deal? So Jinghua, if you could take us through that, that'd be great.
Sure. Thank you, Brendan. John, could we move to the slide entitled Asset Deal Basic Structure? So Brendan and I will first talk about some basics of the asset deal and share deal, which are the two main forms of M&A transactions, and then we will tie that together with these anti-avoidance rules we just discussed. So this slide just shows the basic structure of asset deal, and I think you all know what asset deal is. Basically, when a foreign investor comes to China and they want to purchase existing business, they have the option of either doing an asset deal or a share deal. I have seen most cases when they purchasing business from Chinese sellers, they do asset deal. And sometimes when they purchase from foreign investors, they may do a share deal. The main advantage of an asset deal is really risk control, because if you do asset deal, you don't take over the inherent liabilities of the seller, of the target company, because in a lot of cases they may have heightened liabilities such as tax liabilities or employee related liabilities. So if you do asset deal, you can cut off these risks. However, from tax perspective, asset deal in most cases more costly. Let's move on to the next slide. Because in asset deal, first of all, you need to, just from income tax perspective, you need to deal with two layers of income taxes. One is at the target level, the other one is at the shareholder level. And also, when you do a asset deal, you probably won't take over the tax attributes of the target. For example, the tax incentives in China might be lost, and the net operating losses you cannot take over. In asset deal, there's also probably goodwill and these intangible assets that would trigger a big capital gain that result in income tax. And there would also be a lot of transfer taxes, especially on the marketing intangibles, real estate. In the next slide, we have a brief summary of the major turnover taxes that would apply to asset deal. That's tax not a tax efficient structure, but probably will reduce the risk of the transaction. So I'll have Brendan talk about the equity deal.
Thank you, Jinghua. If you look at, alternatively, if you look at a picture of an equity deal and a basic structure of that, to juxtapose it against the asset deal, you think about it, as Jinghua just described, there's a whole host of taxes that apply if you sell the assets. Then, of course, that means a company is selling the assets, paying tax, and then the shareholder, in order to get those profits, be it an individual or a company, potentially then has another layer of taxes. Those profits that come from the asset sale go up. So tremendously tax inefficient. So what you saw historically was that sellers didn't like asset deals, and in fact they like share deals, but most ideally they really actually wanted to do what we see in a couple of slides, which we can move on to, which is 2 slides down, which is share purchase of an SPV. What people really want to do in China is they want to sell you an offshore company, and that's what they wanted to do. They wanted to sell you a company outside of China, and they historically thought they could avoid paying Chinese taxes altogether. So it went from not paying a whole host of transfer taxes, et cetera, to paying 10% on a foreign seller, capital gains tax on a transfer of shares, or 20% if it's a Chinese individual's other income, to being, I want to sell you this offshore and I want to avoid tax altogether. So the question becomes, in those situations, when we now know that people are still going to push for these types of transactions, these types of structures, if you go to that next slide we have here on 698 considerations, the question becomes, if I'm representing you, Jinghua or I are representing you as the buyer, what kind of considerations and issues do we have? And historically, we've always had a tough time telling clients or talking to clients and our M&A colleagues, our M&A lawyers, frankly, to explain to them why tax considerations are real, why they're issues, because they've always felt very, very theoretical, because enforcement here has been very, very weak. Now that's changed. Jinghua talked to you about the Jiangsu case and some other real-life cases where that's no longer, people can't say, I've never seen an actual, anti-avoidance enforcement or anything of that nature. That's not the case anymore. But even if you take all that aside, think about this. If a seller was to sell you, say, a Hong Kong company, and let's just say they didn't do their 698 reporting. One, there's a possibility that their misdeeds could become an issue for you, because now the offshore transaction is viewed as an onshore transaction, and there's an argument under a notice called Notice 3 that you have an obligation as the target company, which you'll now own, to assist in the tax collection. So that's pretty scary to begin with. But perhaps the scariest part about all this is that as buyer, I'm inheriting the capital gain of the seller. Because when I either do an internal restructuring or at some point in the future when I sell that Hong Kong company, realize that the basis, if I'm going to do my 698 reporting, or if I'm going to get sort of nailed for that transaction in one way or another, now when I do the 698 reporting, irrespective of whether or not they've chosen to do it, but I feel I have to do it because I'm going to comply with the law, I'm a U.S. company, realize that when I do that, I'm going to now be inheriting their basis. So if they sold it to me at 100, but their basis was 10, it goes up another 100 under my control. I'm now going to pay their capital gains tax. And that's the real cost of this thing, and that's the real change to people. So I think that under the 698 side, I think we tend to find that that's really, the real issue with, if you look, the final 2 slides on anti-avoidance, which talk a lot about basically the same thing. So we can kind of wrap it up here, I think. But the issue is that I think 698 has become a real issue, not only for an internal restructuring, that can we come up with a way to deal with it, can we put enough substance in our holding locations, et cetera. But in an M&A context where Chinese sellers are not very accustomed to paying tax and having to pay that tax bill, how much can we accommodate them as buyer? And it's getting more and more difficult to accommodate them, but at the same time, perhaps China's getting real enough in its actual implications that we're being put in a position as buyer to say, hey, enough is enough. We have to comply with the law here, as do you, and it's a reality, and it's something that we're going to have to face, and you can't just tell us we're being unrealistic Western buyers who don't understand how China works. So we think the tide is changing a bit, the environment is changing a bit, but it's still quite a battle.
Great. Thank you so much, Brendan and Jinghua. With that, we'll move into the panel part of the discussion. And before we start asking questions of the panelists, I want to remind folks that you have a questions area in your GoToWebinar control panel. And please feel free to ask any questions there, and we'll do our best to get to them during the remaining 15 minutes of the presentation. And just as a reminder, since I've gotten a few questions from people here, we will send out soft copies of all of these slides after the presentation today. So let's start here, and I'll ask this first question to Brendan. Given the all of the friction and the new enforcement regime that we're seeing, what are you seeing in terms of trends of companies using any sort of entities to move into China? Is it decelerating, accelerating, staying the same? How are companies reacting to the recent changes?
Well, I'd say that the short way to describe it is that companies are struggling, to be perfectly honest. It's a very big change in a very short period of time to be able to go from having BVI and other tax havens be the vehicle through which you invested into China to having Hong Kong and Singapore companies to now having to have Hong Kong and Singapore companies with very significant operations to be able to address the various Chinese concerns. So people are frankly struggling with it, but people are definitely going towards a more harmonized and sort of centralized structure such that they realize that there needs to be more of a hub that holds multiple Chinese subsidiaries. And there needs to be more substance and more operations realistically to be able to claim any sort of treaty benefits or to avoid some of the concerns with 698. But the short answer is people are struggling. I mean, it's a very, very challenging thing for people to balance because there's also not a magic formula that says if you put 10% the number of people that you have in China in your Hong Kong company, you'll clearly get treaty benefits or 5 or what have you. So people are concerned that I'm going to invest all this time and money to put people in a location that I didn't really want to put people just to sort of satisfy these substance concerns and then ultimately not even get a benefit out of it. So it's very tough.
And to that same point, Jinghua, is this adding time and or costs to transactions that people are considering?
Yes, of course, because as Brendan mentioned earlier, just at the end of the presentation, that when foreign investors trying to purchase a business in China, the sellers, especially the Chinese sellers, they not used to paying tax, and they have been using these type of offshore vehicles try to avoid the PRC tax. They probably want to sell you SPV offshore. But with these, with 6 and 8, with all these anti-avoidance rules, we need to be more careful when we look at the transactional, look at the structure, how we get the target. So we need to spend much more time to review the structures proposed by the seller, and we also need to spend much more time to discuss the reps and the warranties, the condition precedent for closing, the indemnity clauses, and also discuss the price of the deal, because a lot of Chinese sellers they don't consider tax is part of the reality. If there's any tax, they normally want to pass on to the buyer. So we do need to spend much more time on both negotiation and the reviewing of the deal structure.
Gotcha.
And John, if I could just chip one other thing on that, which is that just remember that with an audience that I think is primarily from the U.S., we have the sort of the saying that says that there's nothing certain in life, except for death and taxes. Coming from a state-controlled economy where 20 years ago, 25 years ago, everything was controlled by the state, that's just not something people see here. So it's not that given that people are just used to having to pay their taxes. And so it really is a mindset. It's not just that people are evil and awful. It's, in many regards, they just aren't, there's just not that same mindset you have in the States, to be perfectly honest.
Right. That makes sense. We had a couple of folks who are asking for a little bit of clarification on 698, and specifically around the genesis of 698 and where it sits in the Chinese, tax code structure. Where can folks find out a little bit more about 698 and from where did it spring forth? And I would ask Jinhua or
okay, sure.
Okay.
Go ahead, Jinhua.
Sure, yeah. Well, I guess 698 is really the most famous anti-avoidance rule that China put in place, and everybody's so concerned. We actually have a couple of articles on that topic, and we'll also have China alerts that update you regularly on any of the new rules on 698 and any other anti-avoidance rules. So we are happy to distribute these articles and the client alerts to you. And if you're interested, we could also add you to our distribution list of our monthly newsletter.
And I think that just 698, the 698 is basically it's an implementation, as a notice. It's effectively an implementation of the main enterprise income tax law. So the enterprise income tax law and its regulations have more general anti-avoidance language, and this is, I guess, the way you view it is it's an interpretation or it's an application of those concepts. And so it, even if, for example, one of the points is that even if a transaction technically did not fall within the scope of 698, that doesn't mean that the transaction is clearly free of attack, because if it gets captured by the more general anti-avoidance rules, GAR, it could also still be taxable. So the idea is that 698 is a specific application because the authorities have seen 698 as very much the transactions that are covered by 698 as typical transactions that really bother them. And it's been the way that people have avoided, very, very rarely have people ever paid capital gains tax in the past. And so there's a real focus on getting the information about offshore transactions and in turn trying to tax them, because it's viewed as a very real way that people avoid PRC tax.
Great. Next question to you, Brendan. Coming from the U.S., is it still a profitable venture to set up manufacturing in China without an overseas holding company?
Oh, yeah, I think so. I mean, I certainly people are, there's been a lot of changes in terms of the focus, the types of operations people are putting in China, because there used to be a lot of tax holidays that were very different from what we've talked about in this presentation that made China very attractive for very simple manufacturing. But for reasons probably outside of tax, China isn't even necessarily the first choice for very low-end manufacturing anymore. But we certainly have a lot of clients who are manufacturing of all sorts of natures. But costs have gone up, and so there's been a need to be a little bit higher on sort of the supply chain or the food chain. But even without a holding company, there's a variety of ways that you could be looking to minimize. In a manufacturing operation, what you would typically do is you wouldn't be so much trying to access what we've talked about in this presentation and getting treaty benefits. What you'd really be focused on doing is getting good tax planning to make it so that, for example, an intermediary company serves as a buy-sell, so that, for example, you had a Hong Kong or a Singapore or some sort of hub location that looked after Asia Pacific for your operations. And the idea is that location would engage your Chinese manufacturing operator as a contract manufacturer, such that your actual reportable profits in China would be trimmed down substantially. So it would be more of a transfer pricing and risks and functions type of approach, as opposed to necessarily being so focused on your ability to get the lower dividend withholding rate, because you'd really just try to, you try to reduce the profits of China as opposed to trying to bring those high profits out at a low withholding tax rate. So just the psychology has changed in terms of China being a low tax jurisdiction. It just isn't anymore.
Next question for Jinhua, and this is a question that are a little bit of two sides of one coin here. If you were looking at doing M&A in China, should you go ahead and invest in potential holding companies in other tax-advantaged countries in anticipation of doing that, or should you work with the company you're looking to purchase And would it make sense to have them create offshore holding entities in order to facilitate transactions? So do those sort of preemptive moves still make sense given the current regime?
Yeah, well, I don't think there's a one-fits-all answer for all M&A deals in China. So you really need to look at the specific situation. So, for example, if you already have a holding company somewhere, and that company has some other subsidiaries or have other operations that could satisfy the reasonable commercial purpose or economic substance requirements, then that could be a good vehicle to set up your Chinese operation or use to purchase Chinese business. But if you are purchasing, if your seller has a good structure already with offshore holding companies, then it's also a good way to purchase the offshore holding company that already with substance, with economic, with commercial purpose. However, I need to caution you that you probably don't want to get into a situation where the seller would just, for the purpose of this deal, set up a new offshore company and move their China operations under that offshore company at a very low price, and then sell you the offshore company at a relatively high price. So that's kind of the two types of situations we described in the last two slides. These would have the issues Brendan talked about. So, for example, you don't you take on the capital gains of the seller, and you probably would face tax investigations in China after you take over the business. So these are the situations that you need to take caution. You need to look at the seller's proposed structure very carefully.
Gotcha. Thank you very much. And folks, we have just a minute left here, so we're going to go ahead and draw this to a close. That said, we still have a few questions we have not gotten to. We will do our best to work with the speakers and get those questions answered either directly or via Performative.com and the discussion groups there. I would like to thank Brandon Kelly and Jinghua Liu of Baker McKinsey Shanghai office for their time and insight. Wonderful information today. And a great education for our audience. Speaking of which, thanks to the audience for your time and attention today. I realize your time is very valuable, and therefore we've tried to put as much information and interesting data in front of you as possible in a short period of time. But thank you for joining us this morning. We will post this presentation on Performative under Resources. We will also send a soft copy out to all the attendees today, so you will be getting this within 24 hours of the event. We'll also be sending a survey out. We'd like to hear how we could do better next time, so please let us know if you have any thoughts or ideas. Also, if you have questions specifically for the speakers that were not addressed today, and if we can help connect you with the speakers, we're more than happy to do that. And you'll see in the survey there's a simple question there where you can check a box if you would like us to connect you directly to the speakers. We're more than happy to do that. And if we've learned one thing from today's presentations, we know that China has an incredibly complex tax regimen, enforcement regimen, and you need great guides for managing these kinds of corporate structures and M&A transactions, tax-focused transactions in China. And you couldn't find better folks to help you along that path than our friends at Baker McKinsey. So a great thanks to them for helping all of us out today and for helping us present this wonderful information to the attendees today. So with that, I will bid everyone adieu. And we look forward to seeing you again in the future, either at another event or online at Performative.com. Thank you very much.